Hello and thank you for tuning into this week's episode of Bite-Sized Cybercrime, the podcast where we discuss cybercrimes and cybersecurity news in short, digestible episodes. I haven't talked about cryptocurrency and blockchain-based crimes in a while, and an interesting case came on my radar recently that I just had to mention. Cryptocurrency first refers to a wide variety of digital currencies used to complete transactions that you would with real money. The main appeal is that it is not reliant on any kind of central authority like a bank or the government. Another appeal is that many cryptocurrencies allow for completely anonymous transactions, for example, Monero. This allows for more privacy and, well, illegal activities, of course. Cryptocurrency is commonly demanded by ransomware groups due to the ability to have an anonymous wallet. After all, hacking groups would get caught a lot more if they used their real bank accounts. This week we're going to be focusing on Ethereum, and more specifically an exploit that made two MIT brothers $25 million richer in 12 seconds, as the headlines say. So, how does that type of attack even work? There was definitely a lot more preparation than 12 seconds. First, the duo established some Ethereum validators through shell companies, intermediary crypto addresses, foreign exchanges. This was all to help conceal their identity and make it harder to trace back to them. Next, they made some test transactions and then used them to identify variables that were likely to attract crypto trading bots called MEV bots. A MEV bot is a miner extractable value bot, and they basically monitor pending crypto transactions, such as the test ones the brothers were making. Among those transactions, they try to find an opportunity for profit. These bots can then submit their own transactions in ways that exploit both the pending transactions and the market to make a profit. It's been compared to front-running in the traditional stock market if the comparison helps. In the traditional markets, it appears to be unethical and also often insider trading, but with the Ethereum blockchain, it's more of just a reality that can't be fixed, and reluctantly accepted. But as it so turns out, these bots can be exploited as well. There's a vulnerability in the code of many of these bots that can cause a block to be released prematurely. This reorders the transaction to the bot's disadvantage, rather than the intended advantage. It's really interesting. The attack was manipulating transactions as they happened to effectively scam the bots and rake in a lot of cash really quickly. That's where the 12-second figure comes in, although I don't think it's entirely accurate due to all the preparation that had to occur. If we counted how long cyber attacks took by how long it actually took to press the buttons, then many attacks would take seconds. Obviously, this was not an intended mechanic of the Ethereum blockchain. It required a lot of knowledge on the blockchain and also specific behavior of these trading bots. Despite the many efforts to cover their tracks, the brothers were found out and indicted with conspiracy to commit wire fraud, and conspiracy to commit money laundering. It's likely that somewhere along the line anonymous wallets were not being used, or maybe a step was skipped in laundering the crypto. Either way, doesn't seem like all the shell companies helped. As investigators claimed, all they had to do was follow the money. Some believe this type of attack has rather concerning implications. In a Department of Justice press release, attorney Damian Williams claims that this crime calls the very integrity of the Ethereum blockchain into question. Crypto is not exactly my area of expertise, but I see where he's coming from. The blockchain was not necessarily completely shattered open, but fraudulent transactions were permanently etched into it, not just because someone was making false claims, but because those transactions were effectively rewritten as they were occurring. The faulty code that made this attack possible has since been patched. It is relatively unlikely we will see this specific type of attack again, but there is still a lot of opportunities to exploit crypto and blockchains. At the start of this episode, I said that two of the main appeals of crypto are privacy and the decentralized nature. I never said security. The risk for fraud and other types of attacks are a lot higher. This is due to the decentralized nature of cryptocurrency as well as it being a completely digital asset. There's also very few regulations and really no insurance if you do get scammed. If you lose your crypto, it's gone forever. Although I don't know much about crypto, I do find it really interesting, especially as the government tries to regulate it more, and as more vulnerabilities are discovered, either within the blockchain itself or within different trading bots. Anyways, thank you for tuning into this week's episode of Bite-Sized Cybercrime, and another thanks to the Department of Justice, Bleeping Computer, Tech Times, ARS Technica, Business Insider, Medium, and The Verge for information on this attack. It was really interesting to read about. I highly recommend reading the Business Insider source if you're interested in the more technical details, or if you just understand how markets work a lot better than I do, because I feel like it was very well explained. My name is Chloe Tonis, and until next time, stay secure.